December 2nd, 2025. The board is lit, and the evidence is piling up. Everyone is looking at the Federal Reserve meeting scheduled for next week, December 9th. The narrative on CNBC and in the headlines is that we are getting a 25 basis point cut, and they are calling it a victory lap for the soft landing. The market is pricing this at an 87% probability, and the consensus is that the war on inflation is over and the economy has normalized. But I am looking at something else. I am looking at a single data point buried in the technical footnotes of the Bureau of Labor Statistics report that suggests this victory lap is actually a rescue mission in disguise. If you are buying the index today because you think a rate cut is bullish, you might be walking into the biggest trap of 2025, because the plumbing is telling a completely different story than the surface water. Let's open the 3 locked doors. Door number 1 asks why the smart money is quietly loading up on long-duration treasuries and defensive assets while simultaneously hedging against a credit event in small caps. If the economy is booming thanks to AI CapEx, why is the high-yield credit market flinching? Door number 2 is the ghost metric. There is a discrepancy between 2 government datasets, known as the QCEW and the non-farm payrolls, that has widened to a historic gap of nearly 1 million jobs. Why is nobody talking about the fact that these jobs might not actually exist? And door number 3 asks, who really benefits if the yield curve uninverts violently in the next 14 days? I'm going to leave door 3 closed until the end, because the answer will change how you position for January. But first, we need to dismantle the narrative of the victory cut. Right now, the consensus is simple. Inflation has cooled to around 2.8%, which is sticky but manageable. The Fed funds rate is sitting at 3.75%. The market wants that cut to 3.50. The narrative is that the Fed is cutting to normalize rates because the emergency is over. But here is the receipt nobody is reading. I want you to pull up the chart for the birth-death adjustment in the jobs report. This is a statistical model the BLS uses to guess how many new businesses were created. It is a guess. It is not a count. In 2024, this model added thousands of phantom jobs. Now fast forward to today, December 2025. The preliminary benchmark revisions suggest that the U.S. economy created 911,000 fewer jobs than reported over the last cycle. Let that sink in. 911,000. That is almost 1 million people who we thought were working, spending, and paying taxes who simply are not. So here's the first uncomfortable question. If the labor market is actually 1 million jobs weaker than the headline suggests, is the Fed cutting rates because they won the inflation war? Or are they cutting because they have internal data showing the consumer is about to hit a wall? This is where you need to pay attention. The media is focused on AI productivity. They are showing you the GDP boost from the hyperscalers spending $500 billion on data centers. And yes, that spending is real. It is keeping the headline GDP number green. But the labor market is not driven by hyperscalers. It is driven by the small businesses that the birth-death model assumed were opening, but were actually closing. If you are just watching the S&P 500, you are seeing the AI boom. If you look at the Russell 2000 or the QCEW data, you are seeing a silent recession. I will keep tracking this discrepancy weekly with receipts, so if you want the signal before the revision hits the news, make sure you are subscribed. Now let's do a quick temperature check. Based on what I just said about the phantom jobs, do you think the Fed should cut next week or hold? Type cut or hold in the comments right now. I want to see where the sentiment is. Okay, let's go deeper into the mechanics, because to understand why this December meeting is so critical, you have to understand the lag effect. Monetary policy works with long and variable lags. We have heard that phrase 1,000 times, but here's what it looks like in practice. The rate hikes of 2023 and 2024 are only fully hitting the real economy right now in late 2025. Why? Because of the maturity wall. Corporate debt is not like a credit card where the rate changes instantly. It is fixed for a term. A massive tranche of corporate debt is rolling over in the first quarter of 2026. These companies locked in low rates back in 2020 and 2021. Now they have to refinance. If the Fed does not cut in December and signals a pause, yields at the short end of the curve stay high. Those zombie companies, the ones that the birth-death model thinks are alive, will face interest payments they cannot make. The Fed knows this. Powell knows that the 900,000 missing jobs are essentially a proxy for small business stress. If he does not cut in December, he risks triggering a default cycle in the private credit markets right as the new year begins. So the victory cut is actually a liquidity injection to keep the zombies walking for another quarter. But here's the catch, and this is where the smart money is getting nervous. Look at the Treasury General Account, or TGA. This is the government's checking account at the Fed. As of today, early December 2025, the TGA balance is hovering around $900 billion. The Treasury needs to keep this high to handle year-end outflows and the debt ceiling optics.
When the Treasury refilled this account earlier this year, it pulled liquidity out of the banking system. It drained bank reserves. Now, usually, when the Fed cuts rates, it eases conditions. But if the Treasury is simultaneously issuing massive amounts of debt to fund the deficit, which is running at 6% of GDP, that issuance sucks up cash. So we have a tug of war. The Fed is trying to push cash in by lowering the cost of borrowing. The Treasury is pulling cash out by selling bonds. Who wins? Historically, when this happens, volatility explodes. If you want the next evidence board where I break down exactly how this liquidity pump works, make sure you are subscribed. Now I want to pivot to the AI shield. You might be asking, if the labor market is so fake, why isn't the stock market crashing? Because of the CapEx shield. In 2025, AI capital expenditure contributed roughly 1 full percentage point to GDP growth. That is massive. It masks the weakness in the real economy. Construction workers are building data centers. Power grids are being upgraded. That activity is real, but it is concentrated and it is narrow. The risk is that the market realizes the AI economy and the real economy have decoupled. If the Fed cuts in December, the AI trade might actually sell off. Why? Sell the news. They have priced in the cut for months. But the bond market, specifically treasuries, might rally hard. Why? Because a cut validates the recession thesis. Think about it. If everything was amazing, they would not need to cut. A cut says, we see the cracks. And the biggest crack is that labor revision. I want you to look at a chart of the SOM rule. It triggered months ago, then untriggered, and now it is hovering. It is messy. The data is noisy. But the QCEW, which stands for the Quarterly Census of Employment and Wages, is the gold standard. It is not a survey, it is tax records. And the tax records say employment is flat. So here is the scenario for December 10th. Powell comes out. He announces a 25 basis point cut. The market cheers for 10 minutes. Then he starts the press conference. If a reporter asks him about the benchmark revision, and he admits that labor is softer than the non-farm payroll report shows, the algorithm is going to flip. The dollar will drop. Gold will likely bid, and the yield curve, which is the difference between the 2-year and the 10-year Treasury, will steepen. That steepener trade is what the insiders are watching. They are betting that short-term rates will fall faster than long-term rates. Now I have a question for the skeptics. Do you trust the household survey, which asks the people, or the establishment survey, which asks the companies? Give me 2 words in the comments, household or establishment, and tell me one reason why. Let's go back to the rewatch trigger I planted earlier. Remember I mentioned the birth-death adjustment? Here's the detail everyone missed. The adjustment does not just guess new businesses. It lags by 6 to 9 months. That means the numbers we are seeing today in December 2025 are actually reflecting the business creation environment of early 2025, when rates were still higher and credit was tighter. The model is mathematically guaranteed to be wrong at turning points, and the Fed knows it. This brings us to door number 3. Who benefits if the yield curve uninverts?
The banks. Specifically, the regional banks that are holding underwater commercial real estate loans. If short-term rates stay high, their cost of funding stays high. But their assets, the old loans, are yielding nothing. They are bleeding. A December cut is not for you. It is not for the stock market. It is to lower the funding cost for the banking sector before the maturity wall hits in the first quarter. If the yield curve normalizes, banks can breathe. They can refinance. They can survive the phantom job losses.
So let's connect the dots on why this matters for your money right now. We are seeing a divergence between the soft data, which is sentiment and surveys, and the hard data, which is tax receipts and delinquencies. The soft data says soft landing. The hard data says hard landing. The Fed is reacting to the hard data while talking about the soft data. This is why their communication feels confusing. They cannot come out and say we are cutting because the banks are stressed. That would cause a panic. So they say we are cutting because inflation is down. It is a cover story. And the best way to trade a cover story is to watch what they do, not what they say. Watch the reverse repo facility. Watch the bank term funding program usage or whatever facility has replaced it in the plumbing. If liquidity usage spikes while they are cutting rates, that is the smoke signal. It means the system is thirsty. We also need to talk about the consumer. The US consumer has been resilient. We hear that every day. But look at the credit card delinquency rates. They are at the highest level since the global financial crisis for the subprime borrower. The top 50% of the economy is doing fine because they own assets, and assets have inflated. The bottom 50% is struggling. This is the K-shaped economy. The Fed's cut is designed to stop the bottom of the K from breaking completely. But here is the risk. If they cut too early or too much, they risk reigniting inflation. Commodities are waiting for a signal. If the dollar weakens significantly on a Fed cut, oil and copper could rally. That sends inflation back up. Then the Fed is trapped. They cannot cut more, but they cannot hike. That is called stagflation, and it is the nightmare scenario for equity valuations. This is why the job data clue is the master key. If the jobs are not there, the demand is not there. If demand is not there, inflation should naturally fall. This gives the Fed the green light to cut.
But if the jobs are phantom, then the productivity numbers are also wrong.
Productivity is output divided by hours worked. If we are overcounting the workers, we are undercounting the productivity per worker. Or worse, we are overestimating the health of the economy entirely. The revision that comes out in early 2026 is going to be the wake-up call. But by then, the smart money will have already positioned. They are buying the long bond. They are buying gold. They are buying quality balance sheets that do not need to refinance. They are selling the hype and buying the plumbing. I want to zoom in on the specific mechanism of the revision because it is critical to understand the magnitude. The BLS benchmarks the payroll data once a year to the QCEW tax records. Historically, these revisions are small, maybe 0.1%. This year, the revision is massive. It is nearly 0.6% of the total workforce. That is a statistical anomaly. It suggests that the models broke. Why did they break? Because the post-pandemic economy does not fit the old algorithms. We have more gig work, more multiple job holders, and more business churn. The model sees a new tax ID and thinks it is a new business. In reality, it might just be a contractor incorporating. The model counts a job. The reality is zero net new employment. This inflation of the data creates a wealth effect that is fake. It makes policymakers feel confident when they should be cautious. And that brings us to the political dimension. No central bank operates in a vacuum. We are past the election cycle, but the pressure remains. The administration needs a clean economy. A recession in 2026 is politically unacceptable. The pressure on Powell to cut is immense, not just from the data, but from the ecosystem. But Powell cares about his legacy. He does not want to be Arthur Burns who cut too early and let inflation roar back. He wants to be Paul Volcker,
But he also does not want to be the guy who caused a depression by staying tight too long. He is walking a tightrope, and the wind is blowing. The wind is the debt. $36 trillion of federal debt. The interest expense on that debt is now over $1 trillion a year. It is the second largest line item in the budget after Social Security. If rates stay high, the interest expense spirals. The government literally cannot afford high rates for much longer. This is the quiet part that nobody says out loud on TV. Financial repression is the only way out. That means keeping rates below the rate of inflation, or at least below the rate of nominal GDP growth. The December cut is the first step in a long process of bringing rates down to make the debt serviceable. It is not about you. It is about the sovereign balance sheet. So where does this leave us for the rest of December? Expect volatility. Expect the headlines to be confusing. Expect the market to whipsaw. If the NFP number comes out hot on Friday, do not believe it instantly. Look at the revisions to the prior months. That has been the trend. High headline, negative revision later. It is a pattern. And once you see the pattern, you cannot unsee it. The investigation into the phantom jobs leads us to one conclusion. The economy is slower than they say. The Fed is more worried than they admit. And the liquidity cycle is turning. The December 9th cut is highly likely, but do not mistake it for a signal of strength. It is a maintenance patch on a leaking tire. The job data clue is that the tire has been leaking for a year, and the BLS revisions are about to prove it. The play is not to chase the rally. The play is to understand that liquidity is about to shift from inflation fighting to recession prevention. When that shift happens, asset correlations change. Stocks and bonds might stop moving together and start moving inversely again. That is the return of the traditional hedge.
If you want the 2026 liquidity map before the crowd sees it, where I break down exactly which assets historically outperform when the Fed enters panic repair mode, hit that subscribe button. This is not financial advice. It is education and pattern recognition. See you in the filings. But the filings tell a deeper story about the money itself. And to understand why the December cut is a rescue mission, we have to look at the plumbing of the United States Treasury. This is the engine room that dictates whether your assets go up or down, regardless of what the earnings reports say. We need to talk about the Treasury General Account, or the TGA. Think of this as the government's checking account at the Federal Reserve. When you pay your taxes, that money leaves the commercial banking system and goes into the TGA. When the money sits in the TGA, it is effectively removed from the economy. It is dead money. It is not being lent out. It is not stimulating growth. It is just sitting there. Over the last 6 months of 2025, the Treasury has been quietly rebuilding this account, pushing the balance toward $1 trillion. Why does this matter? Because every dollar that goes into the TGA is a dollar of liquidity drained from the bank reserves. This creates a mechanical tightening of financial conditions that is happening entirely in the background. While Powell is at the podium talking about the neutral rate, the Treasury is effectively performing quantitative tightening by hoarding cash. This is the divergence I mentioned earlier. The Fed is signaling ease, but the Treasury is signaling a squeeze. This squeeze hits the repo market first. The repo market is the beating heart of the financial system, where banks and hedge funds borrow cash overnight using treasuries as collateral. If cash is scarce because it is all locked up in the TGA, the cost of overnight borrowing spikes.
We saw this in September 2019 when the repo rate exploded, causing a minor panic. We are seeing tremors of that again right now in December 2025. The Secured Overnight Financing Rate, or SOFR, has been drifting higher. It is a subtle signal, but to a forensic accountant, it sounds like a fire alarm. It means the gears are grinding. If the Fed does not cut rates and inject liquidity, the friction in the repo market could seize up the entire credit machine. This is why the December cut is not optional. It is structural. They need to grease the gears before the year-end funding stress hits. But there is another player at the table, the Reverse Repo Facility, or RRP. For the last 2 years, the RRP acted as a massive buffer of spare cash. Money market funds parked trillions there. When the system needed cash, it just flowed out of the RRP. It was a beautiful automatic stabilizer. But look at the chart today. The RRP is drained. The tank is empty. The buffer is gone. This means that any shock to the system in 2026 has no cushion. If a bank fails or a hedge fund blows up, there is no pool of idle cash to absorb the impact. The shock will travel instantly through the nervous system of the market. This makes the system fragile in a way we have not seen since 2018. This brings us to the shadow banks. While everyone is watching the big regulated banks like JP Morgan and Bank of America, the real risk has migrated to private credit and private equity. These are the shadow banks. They do not take deposits, so they are not regulated by the FDIC. They have grown into a $2 trillion ecosystem. They have been lending to the companies that the banks rejected. These are the riskier borrowers, the companies with high leverage and fluctuating cash flows. For the last 3 years, private credit has been the golden child of Wall Street, delivering steady returns while public markets were volatile.
But here is the receipts-based reality check. Private credit valuations are often marked to model, not marked to market. That means the fund managers decide what the loans are worth based on their own internal spreadsheets, not based on what someone would pay for them today. In a high-rate environment, the borrowers in the private credit space are getting squeezed. Their interest coverage ratios are dropping. We are starting to see payment in kind, or PIK, deals explode in frequency. A PIK deal is when a borrower cannot afford to pay the interest in cash, so they pay with more debt. They effectively add the interest to the principal. It is the corporate equivalent of using one credit card to pay off another. It works for a while until it explodes. We are tracking a surge in PIK election across the middle market in Q3 and Q4 of 2025. This is a sign of distress disguised as deal flow. If the Fed keeps rates high, these zombie borrowers collapse. If they collapse, the private credit funds take a hit. And who is invested in private credit? Pension funds, insurance companies, endowments. This is the contagion channel. It is not about a bank run on deposits. It is about a liquidity run on private assets that cannot be sold quickly. If you want the evidence board on private credit stress, where I show the specific sectors seeing the highest default rates, make sure you are subscribed for the next update. I am building a map of the danger zones that you need to avoid. Now let's look at the commercial real estate maturity wall again, but with a specific focus on the office sector. We all know office is bad. That is old news. But the investigation reveals a new wrinkle. It is the multifamily sector, apartment buildings. In 2020 and 2021, syndicators bought billions of dollars of apartment complexes using floating rate debt. They assumed they could raise rents forever and refinance at 3%. Neither happened. Rents flattened and rates tripled. Now those loans are coming due. The loan-to-value ratios are upside down. The property is worth less than the debt. The banks are currently engaging in extend and pretend. They are modifying the loans to avoid recognizing the loss. They hope that if they wait a year, rates will come down and save them. This December cut is the first dose of that medicine, but 25 basis points is not enough. They need 200 basis points to make the math work. This means the Fed is trapped in a cycle of needing to cut to save the collateral values of the banking system. This connects back to the phantom jobs from part 1. Why is consumer demand softening for apartments? Because the jobs aren't there. If the jobs aren't there, household formation slows down. People get roommates. They move back in with parents. They don't rent new units. The vacancy rates rise. The cash flow drops. The loan defaults. It is a perfect feedback loop. The labor market data and the credit market data are singing the same song, but in different keys. The labor market says stagnation. The credit market says default. I want to pause here and ask you a question about this feedback loop. If the shadow banks start to crack, do you think the Fed will step in to bail them out like they did the banks in 2008? Or will they let them burn? Type bailout or burn in the comments. I want to see 2 words and 1 reason why. Now let's talk about the inflation Trojan horse. There is a scenario that almost nobody is pricing in, but historically it happens in this exact setup. It is the 1970s style pivot. In the 70s, the Fed cut rates to save growth, but they did it too early. Inflation had not been fully killed.
it was just sleeping. When they cut rates, liquidity rushed back into the system, and inflation roared back to double digits. Could that happen in 2026? Look at the commodity markets.
Copper supplies are critically low due to underinvestment in mines. Oil markets are tightly controlled by geopolitical rivals. If the dollar weakens because of the Fed, cut the price of imported goods goes up. We could easily see a situation where growth creates a recession, but inflation stays high. Stagflation. This is the worst of all worlds for a standard 60-40 portfolio. Bonds fall because inflation eats the yield. Stocks fall because earnings drop. So how do you protect yourself? You have to look for assets that have pricing power. Companies that can raise prices without losing customers. These are usually not the high-flying tech stocks that depend on ad spend. They are the boring companies. Utilities, waste management, defense contractors, healthcare. These are the sectors that insiders rotate into when the cycle turns. We are seeing massive insider buying in the energy midstream sector right now, the pipelines. Why? Because they have inflation-linked contracts. If inflation goes up, their fees go up, and they pay a hefty dividend. It is a defensive play that pays you to wait. Let's re-examine the mechanics of the Fed's balance sheet reduction, or quantitative tightening, known as QT. The Fed has been rolling off $60 billion of treasuries a month. They are letting them expire without buying new ones. This forces the private market to absorb that supply. For the last year, the private market has been happy to buy because yields were attractive. But as yields fall, the appetite might wane. If the private market stops buying, who steps in? The Fed might be forced to end QT abruptly. If they announce an end to QT, that is effectively a form of easing. It is a signal that the balance sheet is open for business again. Watch for the phrase balance sheet normalization in the meeting minutes. That is code for, we are scared we broke something. We also need to consider the geopolitical risk premium. We usually ignore this in financial models because it is hard to quantify. But right now, the global supply chain is fragmenting. Tariffs and trade barriers are rising. This is inflationary. It adds friction to the system. If the US government continues to run massive deficits to build out domestic manufacturing, the so-called industrial policy, that is inflationary spending. It competes for resources, labor, steel, energy. So we have the government hitting the gas on fiscal spending while the Fed taps the brakes. This divergence creates turbulence. The December cut is an attempt to synchronize the pedals. But if they get it wrong, the car spins out. I mentioned earlier the discrepancy in the labor data. Let's look at another discrepancy. The difference between gross domestic product, GDP, and gross domestic income, GDI. In theory, these two numbers should be the same. One measures what we produce. The other measures what we earn. But right now, GDI is significantly weaker than GDP. Historically, GDI is the smarter metric. It catches the downturn first. When companies start making less money, they eventually stop spending. The GDP number is being propped up by government deficit spending. The GDI number reflects the private sector reality. The gap between them is the deficit illusion. We are printing growth. But borrowed growth has to be paid back. The repayment comes in the form of currency debasement. This is the ultimate resolution of the debt cycle. When you cannot pay the debt in real terms, you pay it in depreciated currency. This is why gold has been hitting all-time highs in almost every currency in the world. It is sniffing out the debasement. The central banks themselves are buying gold at a record pace. China, Poland, Singapore. They are swapping dollars for hard assets. They know the endgame. The endgame is a lower real yield on the dollar to inflate away the debt overhang. The December cut is a tactical move in this strategic game.
Now remember door number 3 from the beginning. Who benefits if the yield curve uninverts? We said the banks. But there is another beneficiary, the US Treasury itself. The government issues a lot of short-term debt, T-bills. If short-term rates stay at 5%, the interest bill is astronomical. If short-term rates drop to 3%,
the government saves hundreds of billions of dollars. The Treasury Secretary effectively needs the Fed to cut to keep the budget solvent. This is the definition of fiscal dominance. The Fed loses its independence because the fiscal reality forces its hand. Powell cannot keep rates high if it bankrupts the sovereign, so the cut is baked in. The question is not if they cut, but what breaks after they cut. As we move toward the close of 2025, the liquidity conditions are thinning. The holiday season usually brings a lull in volume, which makes price moves more jagged. A small sell order can crash the price in a thin market. This is the air pocket risk. If we get a bad headline on a low-volume day in late December, we could see a flash crash. This is why professional traders often degross their books in December. They go to cash. They reduce leverage. They do not want to be heroes. If you are looking for the signals for January, here is what you need to watch. Watch the high-yield credit spreads. Ticker HYG, relative to TLT. If high yield starts to underperform treasuries aggressively, that is the risk-off signal. It means the market is pricing in bankruptcies. Right now, that spread is tight. It is complacent. But complacency is the precursor to chaos. We are also watching the US dollar index, or DXY. If the dollar breaks below the 100 level support, it opens the trapdoor to 95. A weaker dollar is good for US multinational earnings, but bad for inflation. It is a double-edged sword. The Fed is trying to thread a needle between a dollar collapse and a recession.
I will be releasing the full 2026 evidence board map in the next deep dive, where I break down the exact trigger levels for the dollar, gold, and yields that signal the regime change. If you want that map, not the noise, make sure you are subscribed. This investigation is far from over. In the next section, we are going to open door number 3 fully and look at the hidden trigger that sits in the derivatives market. It involves a massive position in volatility options that expires in January. This is the whale in the bathtub that nobody sees. And now we arrive at the final layer of the investigation. We have covered the phantom jobs and the liquidity drain, but there is one piece of the puzzle that explains the timing of everything. It is the hidden trigger in the derivatives market. This is the whale in the bathtub that nobody sees until it splashes. I am talking about the Volmageddon setup for January 2026. Right now, volatility is compressed. The VIX is trading near multi-year lows. Investors are selling volatility to generate income because they are chasing yield. This trade works until it doesn't. We are seeing a record accumulation of short volatility positions by systematic funds. They are betting that markets will stay calm forever. But remember what we discussed about the Treasury General Account and the repo market stress? If liquidity dries up, just as these short volatility bets need to be rolled over, we get a chain reaction. A small drop in the S&P 500 forces these funds to cover their shorts, which means they have to sell stocks to buy volatility. This creates a selling spiral. This is exactly what happened in February 2018. The setup today is nearly identical mathematically. The December Fed cut is the catalyst that could paradoxically trigger this unwind, because it invites everyone to take maximum risk right before the liquidity rug gets pulled. So let's fully open door number 3.
Who benefits if the yield curve uninverts and volatility spikes? The answer is the volatility longs. The tail risk hedge funds and the smart money insiders who have been quietly buying cheap protection while everyone else was selling it. They are positioning for a regime change. They know that when the Fed switches from higher for longer to panic cuts, the correlation between stocks and bonds flips. For the last 2 years, stocks and bonds fell together. In 2026, they are betting bonds will fly while stocks cry. This is the return of the risk parity trade. And the banks benefit too, because a steeper yield curve restores their profit margins, allowing them to earn their way out of the bad debt hole we talked about earlier. Now I need to give you the master key for the start of 2026. It comes back to that ghost metric from the very beginning. Remember the discrepancy between the establishment survey and the household survey? Here is the twist I promised.
The discrepancy isn't just an error. It is a feature of the gig economy. The establishment survey counts jobs. The household survey counts employed people. If one person has 3 gig jobs, the establishment survey counts 3 jobs. The household survey counts 1 employed person. The widening gap tells us that people are working harder just to stay in place. They are taking second and third jobs to pay for inflation. This means the consumer is tapped out, not booming. When the gig work dries up, which happens first in a downturn, those phantom jobs vanish instantly. The revision in the data is just catching up to the reality on the street. The Fed knows the consumer is running on fumes. That is why the cut is coming. So here is your actionable takeaway. This is not financial advice, but it is pattern recognition. Do not get seduced by the soft landing headlines. The data says the landing gear is stuck.
The smart money is rotating out of cyclical consumer discretionary stocks and into defensive, quality, and hard assets. They are buying the government debt, treasuries, not because they love the government, but because they fear the credit risk in the private sector. They are buying gold because they fear the debasement of the currency required to solve the debt crisis. And they are holding cash to buy the dip when the volatility whale surfaces. We have looked at the receipts. We have tracked the liquidity. The December Fed meeting is not a celebration. It is a signal flare. The job data clue was the warning shot. The revision is the impact. If you caught the clue about the birth-death adjustment lag earlier in the video, then you know why the Q1 2026 data will look terrible. It will reflect the high rates of mid-2025. The future is already written in the lag. I will be back next week to break down the actual FOMC statement and show you exactly where Powell hid the warnings in his word salad. If you want the map, not the noise, you know what to do. This is an investigation into the plumbing of the financial system. The surface looks calm, but the pipes are groaning. Watch the liquidity, watch the spreads, and most importantly, watch the revisions. This is not financial advice. It is education and pattern recognition. See you in the filings.